moving on to Professor Marcello Minenna.
Let me first thank Ambassador Tortabo for his kind invitation today, and I will try to depict a picture about the Italian and South Africa economy and to find what, if there are some common points despite this big recession, maybe the biggest in their history that they have experienced in the last years. Italy has lost 20% of its industry production, and South Africa has lost 20% of its GDP in the last years. Despite the appearances, my point is that these crises have something in common, because the macroeconomic imbalances that are behind this crisis found a sort of a maximum common denominator into prices and exchange rate. Eventually, there are some differences, because the prices I'm talking about for South Africa are the commodity prices, while for Italy I'm speaking about the price of interest rate. In other words, the price of the govies and, in a certain sense, what is behind the public and private debts. Another common point is, I was saying, the exchange rate. We know that South Africa has faced this big recession with a long decline devaluation of its exchange rate with respect to dollar, while within the Eurozone, after the spread phenomenon arises, we have experienced a sort of a fixed exchange rate regime between the member countries that actually is, in my opinion, reducing the possibility of the Eurozone to help the world. Because, the Eurozone area is one of the most important currency area all over the world. And it's quite a pity that we are not able, despite their value of their debt to GDP and in general of the potential of these countries, we are not able to express what we can do. And obviously we can, contaminate with our growth the rest of the world. And from these difficulties, obviously, also countries like South Africa and all other BRIC suffers, definitely. Another common point is what I like to call a risk segregation attitude that the policy measures are, implementing within the Eurozone and also in South Africa. But also here there is a difference. In South Africa, the risk segregation comes from the commodities market. And so about, the prices of commodities and the forex. And obviously, this is a big difference within the Eurozone, where the risk segregation policy comes directly from the policymaker. That is a big deal that we have to face, and actually, I don't see, some room in the right direction of the risk sharing. That is the basis if you share a currency. Because if some countries share a currency, they have to share risks. It's a nonsense that the attitude of the economic policy, monetary and fiscal that we are seeing just move towards the direction that each country has to nationalize or take its own risk. Let me share with you two big examples that actually are very well represented within the Target 2 payment system. In other words, the system that represents the settlement within the banking system, the banks within the Eurozone. The first extraordinary, and I want to share this experience because obviously South Africa maybe in the future could implement some extraordinary measure in terms of monetary policy in order to face what is happening in its country and what could happen also in the relationship with the other countries and currency area all around the world. At the peak of the crisis, we decided the long-term refinancing operation. 1 trillion of euro of loans given to banks. To brutalize the reasoning, because I'm running out of time, with this money, the country, the member country, has just nationalized the public debt and repaid every country the debt that the banking system have with respect to the other banking system of the Eurozone member countries. In other words, private and public risks has been nationalized. Nothing of this money, more or less, or at least a very little quota, has arrived to the real economy. And also the way in which we have implemented the quantitative easing with a strange structure where the central bank gives money to the national central banks in order to, foster the monetary policy, implement a situation in which the risks has been nationalized, this time not through the private banks, like with the LTRO starting the doom loop within state and banks, but this time from the central bank, specifically national central banks. At the moment, if you look at the target 2 account, you will see that we are again close to 1 trillion of credit of the core countries towards the periphery. My view is that recently actually has been recalled in a paper of the European Parliament, is that Target 2 is measuring how much risk has been segregated in each member country in our currency area. Why I'm saying this in this meeting? Because I believe that part of the problem also for the development of countries such as South Africa is a different attitude of the Eurozone policy. Because in this moment, the Eurozone is like a Ferrari that is moving without tires. And power is nothing without control. And regarding the zebra, I would say something. If I would be in Investec, and I leave you the metaphor at this moment, I would make the stripes yellow and red, since we are in Rome. Thank you very much.